Hey everyone, we've got a special episode of In the Money with Amber Kanwar. I've got Mike Rose on the show. He's the CEO and the founder of Tourmaline Oil. This is the country's largest natural gas producer, and natural gas is super fascinating right now. On one hand, prices are terrible and the equities are underperforming the broad market. But on the other hand, there are some major catalysts on the horizon, particularly for demand, that could reinvigorate the sector. I'm going to talk to everybody's favorite CEO, Mike Rose, about how he says Tourmaline is going to capitalize on it. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Mike Rose, thank you so much for joining me on the podcast.
Thanks for having me.
I think we're going to learn a lot about Tourmaline today. You are the CEO and the founder of Canada's largest natural gas producer at a time where a lot of people seem to talk a lot about how much natural gas we're going to need in the world, especially when it comes to AI. And we'll get there, but I would love to start, kind of the origin story of Tourmaline, because it's the largest now. When you started in 2008, I mean, you really started from nothing. What was your vision in starting up Tourmaline? What did you hope it would become?
Yeah. Well, we hoped it would become a profitable company that made shareholders money. It was our third independent oil and gas company that we'd started. And so we'd learned, what we'd done right and what we might not have done as right with the first two, and figured we'd make Tourmaline the best of the three.
Well, I feel like you're being modest because you started that company and you financed it in 2008, which, if people remember, that was not a time where people were willing to write big checks. And I think part of it was because you had made people money in the previous two businesses.
Yeah, that's true. I mean, we sold Duvernay. We'd like to take credit for the timing, but that was all Shell's timing. So they came with an unsolicited bid the Monday of Stampede Week in 2008, which was, in retrospect, probably the peak for oil and both oil and natural gas prices actually on that Monday. So that was interesting. So we came out of that transaction, well capitalized. And you're right, some people had made money from Duvernay and from Berkeley, the company before that. But it was actually a really good time to start if you were well capitalized, because some of the super majors and large companies were parting with assets in the premium part of the basin. And so, we were able to establish, decent sized land positions in the Alberta Deep Basin, and then ultimately in the BC Montney again, which is, what Tourmaline is built around. And those were actually Duvernay Oil Corp's two biggest assets as well, just albeit a lot smaller. So when Duvernay was sold, we were making about 28,000 BOEs a day, and Tourmaline's 650,000 now, so quite a bit bigger. But we knew when we started Tourmaline just how the capital markets work, and, what the energy fund managers were looking for is we needed to get relatively big, relatively fast. So the kind of dreamy days when we started up Berkeley in the 90s and Duvernay in the early 2000s, there was a whole subculture of small companies, and you could take your time growing from 2,000 to 5,000 to 7,500 BOEs a day. The market was a lot more focused and was already on to scale matters, and so we knew we had to get bigger faster. We had no idea how big we were going to be and how things would work out, but you just kind of got to get going.
I'm glad that you brought that up. The scale. Well, first let's talk about the reward to shareholders, because the stock has tripled since you've IPO'd, and that's just the stock price. That doesn't include all the special dividends that you frequently give out to shareholders, including the base dividend. Is size and scale your edge? How do you think about Tourmaline's edge over other natural gas players?
Oh, there's a whole series of advantages that you've got to kind of create for yourself. Size and scale is certainly helpful in being investment grade, but really, if you go back to when the company started, it kind of starts with the rocks. So you've got to be able to pick the right place, and B, secure as much tier one inventory as you can in those plays. And then as you start to develop, you need, an outstanding engineering execution function. And we've been able to build that and kind of attract the best and the brightest. We've always had the mantra that, building and owning your own infrastructure is extremely important, because you control your production and it allows you to be a much lower cost producer. And in the end, that lets you survive what seems like these endless troughs of low gas prices. And it requires a lot of capital and it takes time, but it puts you in a really strong position. And these infrastructure networks, we're the third largest gas midstreamer in the basin via the series of plants and pipelines that we've built. But it makes you, infinitely more profitable and control your own destiny. And then it actually leads into the M&A world a little bit, because sometimes you can secure assets from other companies that are in vicinity of your infrastructure, so you can then run those wells through your pipeline systems into your plants and get lower OpEx than the previous owner of the asset would have had.
I'm glad you brought me perfectly to the terrible, awful price environment that we're seeing for natural gas. And natural gas is, there's a bunch of different prices for natural gas because it's very much a regional commodity. It's based on kind of where you are and where you're selling into. But in if we use the Alberta price, the AECO price, what's going on? What's keeping it down? And when do you think we'll start to see prices move up?
4 weeks.
Perfect. We'll set our clock to that.
That was easy.
There we go. Mike Rose, that's hang on for 4 more
here's
weeks.
Why. So we've had a bit of an unusual circumstance. This would be just looking at the AECO market. So the local Alberta market there is a series of maintenance issues with what we call the East Gate and the West Gate. So those are our two export points out of the basin. And TransCanada is doing maintenance on both of them. The East Gate's now over. And what that did was it backed up. So there were restrictions exporting gas. So it backed up exports into the basin about a BCF a day at absolutely the wrong time. So second half September, when you saw those essentially zero prices for a couple weeks, is actually the lowest point for intra-Alberta demand. So how much gas we use locally. And like in the wintertime, half of all the gas Canada produces gets used up in Alberta. Anyway, that's the lowest point. It was below 6 BCF a day. But what happens between now and the end of October is winter starts. So from here on, demand builds, and it has intra demand. So it's gone from the mid 5s to the mid 6s, but the 5-year average flip between the second half September and the end October is 1.75 BCF a day. So you got that, and that's going to happen. And then the maintenance will be done at the border points. So you've got another BCF a day. So you're at 2.75. And then LNG Canada actually has started, and it's about half a B a day right now. But by the end of October, this is relying on public data we get from LNG Canada participants because we're not in it. It'll be about a B a day. So between second half September and end October, it's over 3 BCF a day increase in demand. And so prices will flip. And the market kind of already knows that because the 26 strip for AECO is just under $3 as opposed to 50 cents is where we were last week. So it's coming.
So you really were serious. 4 weeks away. I thought you were joking. Yeah. It is 4 weeks away. I mean, natural gas is like the original winter is coming, right? That's generally what gets natural gas moving because people start to use it in the winter, and a cold winter is very bullish for it. But then there's, you're talking about the demand side. There's a big oversupply situation. So I'm curious how you think about to what extent the demand takes that excess supply and what that means in terms of price momentum.
Yeah. I would not agree with the big oversupply comment, just a temporary oversupply. LNG is, we can talk about LNG and then we can talk about electrify everything data centers, but LNG is kind of the main driver. So LNG Canada is going to add 2 BCF a day of demand, which is
just for people not familiar, 2 billion cubic feet.
2 billion cubic feet a day. And right now we produce, about 18 BCF a day. So it's as a country. So it's a significant, a 12 or 13% demand increase essentially all at once. And just based on how quickly this basin responds to adding production back, what's going to happen is you pull 2 BCF a day out of a market that is largely in balance. You're going to create a structural sink, and it's going to drive prices up at AECO and Station 2. And that's what we'll see happen. It looks like from the modeling we do and many others, it'll take 2 to 3 years to replace that production. And so it's going to give us a good length of time of higher prices locally. Now, we're quite diversified. We're probably the most diversified nat gas producer in North America. So we sell at 18 different hubs. We're the largest exporter in Canada. So of our 3 BCF a day, 1.25 goes to markets in the US, and we connect to international markets as of 2023. And so a good portion of our gas isn't trapped in the basin. And, we realize JKM, that's the marker for world LNG prices. So we've got 3 contracts to the Gulf. We're the biggest supplier of gas to California, Northern California, and it typically is a market that trades at a significant premium to Henry Hub just because they've made their electricity system quite unstable, and the backup they need that they didn't maintain is gas. So gas realizes extended periods of very high prices on the West Coast. And we continue to look for more ways to grow that way. Anyway, what's Canada going to do on the LNG front? Well, we were 0 a couple months ago. We had 18 projects in the queue, 10 to 15 years ago. None of them happened. They all ended up on the U.S. Gulf Coast. The U.S. is very good at seizing opportunities, and they definitely seized that one. Fortunately, Canada got a second crack at it. And so that's on our West Coast. So between LNG Canada Phase 1, which is that initial 2 BCF a day, then LNG Canada Phase 2, Rockies or Sea Lisms, and then cedar and wood fiber will be about 6.5 BCF a day on the West Coast by, call it 2031. And that's big. What's happening at the same time, the U.S. is doubling that Gulf Coast capacity from 12 to 25 BCF a day. And Mexico is building out 5 BCF a day of LNG exports. And those are all destined from the 3 countries to either go to Asia or Europe, who have become a much bigger consumer of gas that if we can get it to them. So that's the LNG part. I'll back up a little bit and just put nat gas in perspective, the whole global market, because we seem to concentrate on LNG and, and then there's notes by Goldman Sachs saying, oh goodness, with all this build out, we're going to be oversupplied with LNG. The global gas market today is 400 BCF a day, and LNG is 60 BCF a day of that. So it's an important but not enormous piece of it. If you're a gas producer and believe in gas, which of course we certainly do, the global gas market has grown by 7 BCF a day per year for 50 years in a row. And it's an absolute dead straight line. And so that it's
in terms of demand,
in terms of global demand. And so any temporary oversupply, wherever it is, it won't last very long. And then with this kind of electrify everything movement that's going on, that 7 BCF per day per year growth is going to inflect upwards. So that's why we're bullish in the medium and long term. And then locally, we've got a great story happening in our domestic basins.
So let's summarize some of these points. Prices are down, but you're optimistic they're going to go up. In the meantime, because of the way you sell your natural gas, you're not necessarily beholden to those weaker markets. As you said, you can sell in to California, and then you've got liquid natural gas, liquefied natural gas that's going to start to make its way to international markets. Like that's kind of the whole promise of LNG, right? Is that this demand this supply can make its way to Asia, and then you would step in, I guess, and fill in that supply that is kind of gone elsewhere. I'm curious, as LNG Canada does ramp up and move to its second phases, like what does that do for your mix and where you're going to sell into?
Yeah, well, we'll grow our gas production, between now and 2031 from 3 to 4 BCF a day, and a good portion of that will stay local and supply the growing LNG opportunity on the West Coast. We're in
when do you expect that to show up at Tourmaline?
Well, it'll show up systematically over the next 5 to 6 years, like kind of spread over the full. We've got 4 big projects within our Northeast BC build out that will systematically add those volumes. And we've been waiting until LNG Canada and the other projects get going, because that's going to create the pricing environment such that that's when we should bring new volumes to the local market. Really, the last 2 years, any growth we've had, we've exported it either to California or to the Gulf Coast. And it's hard to establish those export points. It sounds easy, but, kind of A, you have to be investment grade, and B, we've got a fantastic group of marketers who have been able to stitch together the pipeline routes on existing pipelines to get from our basin, all the way down to the U.S. Gulf Coast.
I think that's a point for people not familiar with the space, a point worth underlying when people talk about Tourmaline. Yes, they love your special dividends, but the marketing point, your ability to sell into other markets, people might not appreciate that not just any natural gas company in Canada can sell to California.
Right. You've got to, establish firm transportation, and then, B, establish the markets on where you get the gas to. So this strategy, we're in year 11 of it. And the company's only 17 years old, so we've been working very hard on it. And it kind of goes to when you said, well, when you started Tourmaline, what did you need to do? One of the things that's changed, when I left Shell 32 years ago and started Berkeley, today you need to be the best or almost the best or one of the best in pretty much every aspect of the business. Like in the old days, say in Berkeley days, we were good at exploration and deal making. And so, we put together a pretty successful company that way. Now you've got to be, you got to be the best at the subsurface. You got to have a fantastic engineering execution team. You got to have marketing foresight. You need all of it to be successful. So, and then you need a government relations function that, 5 or 6 years ago, it never even occurred to us that we'd have 5 people in our GR group. and they're really good too.
To deal with all those foreign governments that you now have to make deals with or get on side with?
Yeah, I mean, really, we just have to get on side with our own. We don't work.
Don't worry, we'll get to that, Mike.
We don't work on the landed side with LNG, so that's another whole layer of sophistication that we're not quite ready for yet. Maybe 5 or 6 years from now, but those are established markets, and you've got to know what you're doing, or you can perhaps lose money if you don't make the right deal. So we basically give up custody of the gas. Say the stuff we send to Cheniere, we give up at plant inlet, their LNG plants, but we get the JKM price minus the tolls for liquefaction and shipping on the boat. So we can actually track where our molecules land. And some have gone to Asia and some have gone to Europe. So it's kind of fun.
So, one of the things that is weighing on the sector, as we've discussed, is kind of this indigestion around getting LNG Canada up, obviously the pricing environment. But we have to talk about, recent announcements made by Tourmaline that I think have weighed on the stock. And one of the things that a lot of people have been talking about is your big spending plans. Was it a month or so ago, maybe more, you released your kind of 5-year capital spending plan. And most said it was way higher that many people were expecting, and your stock came down a bunch.
Yeah.
It's recovered.
We had feedback from some quarters like that. Our long-only big shareholders actually love the plan, and they say this is exactly what you should be doing. It was more money. It was a 7-year plan. Actually, it wasn't a 5-year plan. And some of the short-sighted thinkers sort of took the old 5-year plan, which took us to 750,000 BOEs a day, and then compared it to the new plan. And yes, there was more capital in the early years, and production was the same. So, okay, well, gosh, I don't like that. Fair enough. But, what they failed to kind of acknowledge was that production actually ends up at 850,000 BOEs a day. And there's capital spending in those first 5 years now that set up the second 100,000 BOEs a day. So the company ends up 30% larger from a production standpoint. Cash flow improves by between 40 and 45%. And free cash flow on the pricing scenario, the flat pricing, is up by 250 to 300% because the investments we're making actually improve every operating metric for Tourmaline. So this BC build out, it's our most liquid rich, lowest capital cost resource that we're developing. So as that 200,000 BOEs a day, which is what the project's going to deliver over 6 years, to be fair, creeps into the overall production mix, our OPEX goes down, our transportation costs go down, and our realized margins, particularly on liquids, go up. So, it's not just about growing, it actually makes the company materially better. And, we've been kind of telegraphing this for a long time because we'd done 5 years worth of acquisitions in Northeast BC, and we think our timing was really good. And now we're kind of done. And then the next 5 years is let's go realize all the upside and from those acquisitions, which is absolutely there. And, everyone acknowledges that part and go make the company and shareholders a whole lot of money. So I think elucidating it in a little more detail helps. The other thing that perhaps we could have done a better job on that announcement was that the benefit, like some people looked at it and went, yeah, this is awesome. This is what you should be doing with all you bought. But gosh, I don't want to wait till 2030 or 31 to see all these benefits. The benefits accrue every year through the plan. And so we'll make sure we elucidate that. So as we knock off components of the facility build out, we'll document what the OPEX and transportation cost reduction is and what the increase in free cash flow is from those various pieces.
So this spending plan is to kind of realize the benefits of those acquisitions over the last 5 years? Because I think that was the question mark is all of the spending going to yield higher production, Or is it kind of building out infrastructure to make these operations run a little bit more efficient? I'm hearing from you, it's column A and column B.
Yeah, it's both. And we're already the largest liquids producer in BC, so there's a whole liquids piece to the story, and we'll be a large enough producer that, we could run our own unit trains, and there's all kinds of benefits that'll accrue. So yeah, kind of the tagline we have is, we're not just making the company bigger, we're actually making it a whole lot better by investing in the best resource we have. And all the while, we'll solve for free cash flow and continue paying dividends. So the other part that I think, maybe people got worried was we're just going to go spend this money no matter what the price environment is, which is a bit disingenuous, because if you look at our track record, especially as we were talking about dealing with, endlessly low gas prices, if the price isn't there, we defer capital and defer production, which is kind of unfortunately what we've had to do in 24 and 25. But if we have to do it in 27 and 28 because prices are bad, we will.
So I want to pick up on that point that, a lot of the response was, well, this is assuming $4 AECO. What if that price doesn't show up? So it sounds like you're saying, well, then you defer.
Yeah, and we don't need $4 AECO to make it. I mean, with our market diversification and our low cost structure, we're profitable below $2 AECO. So, in 26 off lower pricing than where it is today, our free cash flow was $1 billion. And every dollar on AECO is another $500 million in free cash flow. So if we get $4 AECO in 2026, free cash flow is $1.5 billion, not a billion. So the torque to the upside is huge. But, I don't think anyone can pivot faster on capital spending, either less or more than us. Unfortunately, it's just always been less for the last couple of years.
Yeah, I wonder if we think about it the other way, like what happens if you don't make these capital spending investments?
Yeah, well, production grows more slowly and we'll still generate lots of free cash flow, but we're presenting a case that's pretty reasonable pricing. Well, it's stripped for the first couple of years and then flat pricing. It was 65 WTI and $4 Henry Hub and AECO, which if you kind of look at the broad North America supply-demand dynamics is probably not that high a price. We averaged well over $5 in 2022 for the record, before LNG Canada.
Yeah.
So yeah, we're excited. And that differential between US prices and like Henry Hub and AECO should start to tighten. So if you actually took the current 26 strip AECO price, which is just a little bit under $3, and brought the differential, I think it's $1.75 today, back into its historical range of $1, which is probably where it should be with LNG Canada Phase 1 on in the wintertime, that automatically by math makes AECO $4. So we're not that far away.
Okay, we're actually going to take a quick break. We'll be back with more from Mike. But first, in the third part of our mini-series about cross-border investing, I spoke with Darren Coleman of Portage Wealth, which is part of Raymond James, one of our sponsors at In the Money with Amber Kanwar. And we talked about how love and marriage can complicate your investments. It's one thing to have cross-border issues come up because you're moving to or from because of work. How does marriage complicate things? Love can complicate a lot of things. What happens if you're Canadian and you're married to an American?
Yeah, we like to say that you didn't just marry for love, you also married a tax regime. And the reason that happens is that Canadians are taxed based on their residency, whereas Americans are taxed based on their citizenship. So if somebody is American and lives in Canada, they still have to abide by all the US tax rules. And that can create some really interesting complexities that people didn't expect. One of the most common situations we see is where a husband and wife own a home together and they've had it for many years and it's appreciated in value. For the Canadian, they have the principal residence exemption, so they don't pay any taxes on the gain of the property. The American spouse, not so much. A portion of that gain might be subject to American taxation. And they should know that because they can take steps to avoid that situation. But if they only find out when they sold the property or if someone's passed away, that's not a great surprise.
You might think that you can avoid all cross-border issues if you're not an American, you're not married to an American, and you have no plans to live there. Does that mean that you don't have to consider any of these issues?
You'd hope that would be the case. But interestingly, if someone in their own portfolio owns more than $60,000 of what's called American situs property, so they own shares of Microsoft, NVIDIA, Apple Computer, what have you, in the non-registered account, well, when they pass away, that could be subject to the U.S. estate tax. And so if they want to take advantage of the exemptions, their estate will have to file a U.S. tax return on those assets. So even though they're not American, they may have never lived in the United States, and may never even step foot there, it's their portfolio that could cause them that challenge.
So the threshold is
$60,000.
$60,000, not even 60%.
Right.
Is that the case even if this is in a registered account?
No, RSPs fortunately have an exemption where that's not required. But it's very common that people will have more than $60,000 of U.S. securities in a portfolio when they pass away if they're older. And a lot of people don't know this. So this will be subject to their executor having to file that U.S. tax return.
Darren, thank you so much. There's so much to consider when you are talking about cross-border transactions. And if you want any information about any of the issues that might come up, you can visit portagewealth.com. A lot of people love Tourmaline for the special dividends. And you know that one of the anxieties around the spending program that you have is, what is this going to mean for the pace of special dividends? And I'll read from a downgrade, and let me finish before you guffaw. I feel like you are going to guffaw at it, but basically saying that, with the capital program and the base dividend, that will consume about 91% of your cash flow next year, which leaves little flexibility for additional dividends. And if you were to allocate all of your free cash flow to dividends, the level would be about 40% below what you've paid out so far in 2025.
Yeah, and that was at the strip at the time, whoever made that announcement. So, there's two pieces to the dividend. There's the base, which we've been growing consistently, and then the special, which, if you go back to 2022, has been shrinking. So we'll see if where the combination of the two goes. But with where we believe 26 is going to be, we're going to be able to accomplish the growth spending, and we'll manage it to where the price is, and being able to certainly maintain and hopefully grow the base and have a special as well. So, but
it sounds like maybe it continues on that trend of being smaller than it was before 2022.
Yeah, the special has been pretty flat. I think it got as big as $2 in a couple quarters back in 22, and now it's 35 cents. So, yeah, it's come down a long way.
It's not supposed to be the guarantee, but I guess when you give it away, do it so regularly. The goal
in the long run, when the pricing environment allows us, is we'll just have a much bigger base, and eventually specials will be quite a bit more sporadic. But we want to have that kind of 4 to 5% yield is the goal.
You mentioned how Tourmaline, there's been a lot of organic growth, obviously, but also a lot of acquisitions in the last 5 years, and you're consolidating. You recently, as early as this year, bought some assets in part from Strathcona. And it seems like recently you've been kind of funding these deals with stock as opposed to cash. Why is that?
Well, in the Saguaro consolidation, so we bought the first half of Saguaro in 2021, and then we bought the second half around the same time that Strathcona came to market. The long and the short of it is both vendors wanted Tourmaline stock, and it would have been more expensive if we'd just done it with cash, because they wanted the upside in Tourmaline stock. So that's the simplest explanation for that. And they're both fairly small deals. Why did we do them at all? Well, we're going to build this cost reduction, margin improving infrastructure right over top of those assets. And so you might as well get them before you make them that much more profitable, because that's going to cost you quite a bit more. The Strathcona deal was kind of a one-off. I had tried to buy that asset 12 years ago out of Pengrowth. And then Strathcona eventually bought Pengrowth, and Adam had said, "No, you know what? We're going to keep that." And then, in Q1, he called me. And so we put a deal together.
You know Adam well?
Yeah, I know Adam. Yeah.
Are you peeking over? I know it's not really your business, but are you peeking over to what's going on with the Meg Energy, Cenovus Energy, Strathcona?
Yeah, we just kind of watch from the sidelines. There's not very many hostiles in the Canadian oil and gas business. I dealt with one because Berkeley in 2000 was bid by the Hunt brothers, and we eventually ended up selling to Anadarko. So I know a little bit more than probably most people, and all the analysts that write about it have no idea.
Tell us,
it's
shed some light.
But it's very interesting. And
I've talked to Adam about how you must know these people. That you're flinging things around, you're writing things in press releases. They know you as well. Like that's it maybe it's hard to feel like it's just business.
Yeah. Oh, for those involved, for sure. But all the people involved are great people, and they've done a great job, and with all three companies. So we'll see how it all shakes out. How
do you think about your future deal flow? Do you feel like you're done? Is there more consolidation? Is there? Do you still see places where you can be opportunistic?
Yeah, but generally, you said, are you done? You're never 100% done, but really it's just small, little asset tack-ons at this point. If we can pry a piece of land out of one of the majors that fits better with us. And, by maintaining the same geography for Tourmaline, really since we started, we kind of know these, what fits and what doesn't. And reality is with the inventory we have, we don't absolutely have to have anything else. But if you can get something at the right price and get it through your infrastructure, sure. But, the acquisition phase, as I pointed out, we spent 5 years, most of the consolidation being in BC. We did some in the Alberta Deep Basin too, but it's largely over. And now the focus is go realize all the upside and make shareholders a lot of money from what we've acquired, because we're going to.
Let's talk about AI and the electrification and all of the trillions that are being poured into, literally trillions that are being poured into building these centers, and all the power that's going to be needed for that. Obviously, not showing up in the price of natural gas, though. You have, so many people say that has to be part of the solution of powering these businesses. How do you think about AI and what it means for the future of your industry?
Well, just on kind of the gas demand part, let's start there. It's real. It's a sleeve of demand. I'll be fair. We weren't thinking about this 2 years ago. I thought a data center, it was those kind of empty buildings full of computer banks in X-Files when Scully and Mulder were scurrying around and people were chasing them. And that must have been a data center. Anyway, they're real. Electricity requirements are enormous. Gas will just be part of it. But even if it's a third, and, some estimates have it being more than that, the incremental demand by 2030 in the U.S. is, and the estimates are all over the map, but call it conservatively somewhere between 5 and 10 BCF a day. So that's 3 big LNG plants starting up that weren't even on the radar 2 years ago. And that's going to be we think the U.S. is going to get really tight for gas supply, because their basins are further on in development life, and a couple of them we think are going to tip. In Alberta, it's real. The climate is good. We do have, one deal that's sort of, I don't know how much is announced and how much is rumor, but Pembina certainly got something going.
Yeah.
And they were allocated 0.9 gigawatts of the 1.2 that the premier is going to allocate. So that'll be our first project. We think by 2029, it's an extra 1.5 to 2 BCF a day of demand intra Alberta, which is enormous. That's like another LNG Canada phase 1 or
And sorry,
phase
what's the
2.
timeline on that? Like soon?
Like by 2029,
Yeah.
you'll start to see, some of the consumption happen in 27, and that'll be on the 2 brownfield sites where there already is less efficient generation that's idled, and it can be brought on stream quite quickly, and those plants will consume quite a bit of gas. I mean, it's the Trans Alta and the Capital Power plants. And then I think there were 17 gigawatts lined up at the ASO, vying for electricity for this data center business. The premier decided, we're only going to allocate 1.2, which is smart because they have to be careful not to bang up prices for the citizens of
Right.
Alberta. And so there's about 2 gigs of excess power. So I think that was quite prudent. So what that drives is behind the fence power generation. So if you want to build a data center, it's like bring your own power. And you can connect to the grid for redundancy, but you're going to have to generate your own power. And so, we're looking hard at that. Can we fit in that? Is that another sleeve of gas demand in our diversification portfolio?
So what does that mean? Like striking deals with those like hyperscalers?
No, that's who you'd need to come in and do something. It really just means, we can provide gas supply, but we have, in the Alberta Deep Basin, we have a great slew of plants. So we have plants, we have land, we have water, we have power redundancy. We're close to fiber. We own the disposal rights in the back half of, or the south half of the Deep Basin. And so that, gives us a real advantage. If a hyperscaler wanted a full green solution, we could provide that and the CCUS piece. So we'll see. So we're not going to build a power plant, and we're definitely not going to build a data center, but we can be on either end. And then what you'd be seeking as a gas producer is, can you get a relatively high fixed price for an extended period of time? And with all the bells and whistles that we can offer, I think that would be a pretty good price that shareholders would be happy with. So we'll explore it and see if it's an option or not.
I mean, you look at how investors are just hungering for any exposure, small modular nuclear reactor stocks, like these AI stocks flying off the shelf. You just, Sam Altman of OpenAI just mentions any company out there, and their stock kind of pops up 5%. Do you feel like the natural gas part of the story, like, is that on investors' radar? Like, how do you think about that?
Oh, yeah, I think so. I think we just need to see, some more tangible evidence that, 2 or 3 or more of these projects are going to happen in Alberta, and then it'll creep into the valuations here. It certainly has with the large U.S. gas producers. So you've seen, some of our peers south of the border announcing, big allocations of their gas to generating power for data centers, and they're starting to do JVs with hyperscalers. And so, yeah, it's exciting. And so that's the gas demand part, but you're going to ask a question. So
you go. Finish your thought. What was your thought?
Yeah. So then, you asked about AI, and then it's like, well, the other side of it is, can it make our business better? And yeah, for sure it can. And so, we're looking at that in a number of different pieces of the business, from G&G or geophysics. There's an enormous amount of geophysical data on those 3D surveys that you kind of don't look at. If you're drilling Montney wells, there's 2 or 3 loops on a seismic line is all you look at, but there's this enormous data volume, and it's really training up a bot to recognize patterns and then tie that to what's happening in the subsurface. So that'll be kind of the next generation.
And are you like, is that like stuff you're experimenting with, or that's like fully part of your business right now?
We're experimenting with it. It's not fully part of it, but we're using elements of it already.
And you see a benefit? I think that's like, it's such a big question. Yeah. You totally see a benefit. And it will lead, it's like, it's going to lower costs for sure. Does it?
It could be lower costs and increase opportunities. So they're both. And then, we're trialing, certain AI tools out even in the production end of the business for kind of optimizing production and learning and, optimizing pressures and what wells are doing. So there's a number of new tools, and, we're trying to understand them as quickly as we can and figure out where the applications are. So that's a great thing about hiring lots of young, smart people, because they actually know how to do all this stuff. They just tell me about it.
That is true. They know so much about computers and AI. I listen to these kids at school, like how they're using it. I use it for like recipes, and they're using it to help supplement their homework or help them prep for SATs or whatever it is. Their imaginations are wild in how they're using the technology.
Yeah. And the fun thing here is seeing, how people very quickly apply it to their day-to-day business. Like, will this apply here? Can I do something differently? And there were, developing AI, even in some of the drilling tools. It was, we called them smart tools, something like rotary steerable technology, which has been a breakthrough for how quickly we can drill these Montney wells in Northeast BC and so forth. So yeah, it's fun. So sky's the limit on that front.
So how can Canada capture this moment, whether it's AI, whether it's just the opportunity of being kind of an energy superpower? I think that's very much the conversation right now under Prime Minister Mark Carney, looking for progress on anything related to that, whether it's pipelines, whether it's attracting a hyperscaler. Go ahead. I got to dust off the soapbox. You get right on it. Mike, can you tell me?
Yeah, well, all of those can make us an energy superpower. I mean, what you need is, an investment climate and a regulatory regime that lets private capital, know all the ground rules, know the timelines, and makes them comfortable committing literally trillions of dollars. The federal government, the new federal government has been, very supportive of natural gas and LNG, and we appreciate that. So they were behind LNG Canada Phase 2. That was in their first 5 projects announced. I mean, it was already approved, but I think they're working at perhaps some of the, emission requirements to make that, much more likely to FID. Rockies or Sealisms, which is a project we're in, that was on their, second list. And so they want to get that one done. And that's part of the getting to 6.5 BCF a day on the west coast of Canada.
So does it seem like we're moving in the right direction in a way that we weren't before?
It does. The regulatory regime hasn't been fixed yet, but there's lots of encouragement for projects. And so I think in the end, you need to do both. But the environmental cert, if you like, for the Sealisms liquefaction facility was granted a couple of weeks ago, both by the federal government and the BC government. So, those are tangible little, anecdotes that say, yeah, you know what, we're heading the right way. We get asked what other projects. Keystone XL got brought up, and I've been pushing for some time, particularly with our Alberta government, is like we should build a line. Whether Keystone XL oil happens, we should put a gas line straight to the Gulf, because they're going to need the Canadian gas in the first half of the next decade.
What do they say when you say that?
Well, and that's a great idea. How much is it going to cost? And what approvals do we need? The good news, that pipeline would go pretty much through red states. And there seems to be certainly a much improved approval process in the United States right now. So maybe that happens. So Keystone XL just goes to Oklahoma. So you'd need to build the continuation of the gas line to the Gulf. But yeah, why not? Why not do 2 to 4 Bs? So it's very important for Canada to diversify our markets, both oil and gas, to give us more leverage. I totally agree with that. And we're heading the right way on the West Coast with LNG. So you'll be 6.5 Bs, and that will go to Asia. That's not going to Europe. But we should never forget that we have a very large, hungry trading partner to the south. and they need our hydrocarbons, and so we don't ignore that, and we should be working both.
And it's going to have to be, I imagine, financed in Canada by Canadians. It's certainly an environment right now where the foreign players, they've exited and they haven't really come back. You mentioned, in 2008, selling your assets to Shell, which I think some of them you actually bought back as Shell sort of got.
Yeah, we did. We bought most of it back in 2016. So
cheaper. Because Shell, this is a big foreign company. They get kind of phasey with Canada, and right now the phase is off. Right, foreigners are not super interested in being in Canada.
I'd say the phase was off, but it's kind of back on.
Tell me why.
Because they've got LNG Canada phase 1 on now, and hopefully we cheer for them a lot that they FID phase 2. But
final investment decision for those.
There are European companies poking around in Canada for assets and gas and LNG. And you saw the transaction with Petronas and MidOcean. Now that's a Saudi Arabia backed company, but they're looking to secure gas supply for Europe.
So they're poking around. When do you think we'll see? Do you think we'll see more deals? What do you think the catalyst would be for that?
I do. Well, actually, the Petronas MidOcean deal, it's hard to distill the metrics because there wasn't a lot of publicly released data. From what we've been able to ascertain, it looked like the EP assets went for a premium, leave it at that, over certainly what they're being valued at in the market right now for the Canadian producers.
Does that mean they're sniffing around your assets?
Oh, no, just the basin in general. Yeah.
One of the things that you mentioned is that the progress that we've got on some of these approvals, I think you used the word small, it's anecdotal. Would you like to see a little bit more gusto? And what does that gusto look like? In a perfect world, Mike Rose wakes up and says, these are the things that have happened to change to get us to where we need to be as a country.
You know what? If as a gas producer and being selfish for Tourmaline and its shareholders, if we got 6.5 BCF a day on the West Coast, which with phase 2, LNG Canada and Rockies, and that pipeline, I think, could be at 4 Bs a day, but right now we're all assigning 1.7 BCF a day to it. 6.5 Bs on the West Coast, that's going to be brilliant for the Canadian gas producers and the Canadian gas market. Yes, yeah, putting my Canadian hat on, there's way more things you can do. There's what I'd call not Keystone, but Alberta Express. That's what I think we should call it.
I like that.
I think there already is an Alberta Express on the other side of the continent, but in the U.S. But anyway, send that one to the Gulf. We should consider shipping another B.5 on the main line into Ontario because they rely on some Marcellus gas. That's certainly a market that could be Canadian. We're the industry backer for a project called Nistanan, which is 100% Indigenous owned. And that was a project connecting Alberta, Saskatchewan, and Manitoba to Hudson's Bay, because that's the shortest route to, and that's for LNG, and that's the shortest route to Europe. It's definitely in the formative stages, and the earliest that could possibly happen would be mid next decade. But certainly another outlet for Canadian gas going that way. And then, in the Saguenay project, it was like that actually looked like a really smart project to me. Berkshire Hathaway was in that project, and then they walked away. But I think it can be electrified because of Hydro-Quebec, and it's just overcoming some temporary objections to oil and gas in Quebec.
Do you think the conversation? Yeah, temporary. Do you think the conversations around Canada's importance to the U.S. and the U.S. energy equation, is being diminished at a time where, Canada is trying to figure out the new relationship with the United States? You sell into the U.S. What's reality? Do you feel you're being penalized as a Canadian company in some ways?
No, not at all. There's when the president says, we don't need Canadian gas, he's largely correct. The vast majority of their gas they source themselves. But there are certain places where they desperately need our gas. And so the Midwest, California, parts of the East. And so we do rely on each other. We're completely intertwined in the energy world. There's 4 million barrels a day in the mid-continent refineries that need the Canadian oil sands blend. That's very clear. So we need each other. So, in the longer term, I'm thinking we get by this business that's going on between the two countries right now. Not everybody agrees with me on that, and they think this is some kind of permanent change in the relationship. But I look at it more as a North American energy superpower, and we can work together, and we should. We can be the U.S. already is the biggest LNG exporter. Add in Canadians 6.5, we actually could very easily and support for decades 10 BCF a day on the West Coast. Go capture all those international LNG markets right now. Get ahead of China and Russia. They're going to grow on their own at various times. But the trick is getting those markets connected to your hydrocarbons. And then we are an energy superpower. And of the top 8 producing oil and gas countries in the world, there's only 2 democracies, Canada and the US.
Good perspective. I'm going to let you go, but before I do, you've been at this 17 years at Tourmaline. It's your third company.
Yeah, 47 altogether.
47. Don't you want to be on a beach somewhere, Mike Rose? Do you think about succession planning and what that looks like? Maybe going down to part-time?
No. Well, if I was on a beach somewhere, I'd be looking at well tests on my phone and then complaining to the IT department, I can't see them. You got to put them on bigger font. But no, as long as I'm still adding value, yes, we have a succession plan. We have hired fantastic people, over the years at Tourmaline. And, there's all the disciplines have an existing and a young leader to replace them. And so we're set. And as soon as it's clear that I'm not adding value anymore, then the board will probably move me out. Won't be my choice.
I'm sure they'll give you a nice office, though. Nice office. You still be executive chairman. It'll be great.
Yeah. And just getting in the way of everything.
Well, let's find out your vision. We talked about at the beginning of this interview, from zero to the largest natural gas producer in Canada. Your vision for the next 10 years. What is Tourmaline? What does it become?
Well, it's going to be Canada's best and most profitable gas producer, in the top 3 in North America. Very strong return to shareholders, decades of inventory. Like we talked about that BC build-out, the beauty, just given how long our inventories are, by the time you get to 2031 and this build-out's over and we're 850,000 BOEs a day and paying $3 billion a year in free cash flow, we can do that for decades at flat pricing, which most of our U.S. peers don't have the inventory length to do that. And do good in Canada, build more baseball diamonds. I'll do that on my own. Tourmaline won't do that. But yeah, just be, a great corporate citizen and contribute to the prosperity of the whole country. And the beauty of LNG is that you have to replace 1/3 of the production every year. And so there's a tremendous number of jobs across the country that are lasting jobs for decades to maintain those production levels. That's the difference between LNG and resource plays and, say, the oil sands. Huge investments to get the production up and running, but then low decline rate and not as much annual spend, not as much job creation. The gas business with resource plays, it's a treadmill, and it's a really big treadmill, and it goes really fast.
That's why you're so fit. You've been running it for 47 years. Mike, thank you so much.
You haven't seen me on the treadmill.
Next episode.
Mike, I don't think you want to.
Mike, thank you so much for joining me. It's been an absolute pleasure getting to know you and the Tourmaline business.
Yeah. Thanks, Amber. Thanks for taking the time. Appreciate it.